So welcome everyone to this introductory session for finance education for investors. So this is the open night. Sounds like we're going to be doing karaoke here at the open night, but actually it's not going to be that at all. It's going to be a demonstration of the course. So I'm going to take you through some examples. We're going to fly over the course in a sense. We're not going to go in. We're certainly not going to start at the beginning and work through the course. I'm just going to give you a flavor for what the course is like and explain what all of the content is and answer your questions. Now, I'd ask you to, and this happens in the course as well, I'd ask you to write your questions into the chat, and I'll come to them at the end. I mean, typically we just have too many people to stop and start with direct questions. Sometimes we do that, especially if someone is visiting the course, which happens once or twice with insurance and with structuring and tax. But I'd ask you to write your questions into the chat, and I'm going to talk for about 45 or 50 minutes, show you through the course, and then we'll come to that. So just write your questions in the chat, and I guarantee I'll answer all of them. Okay, let's jump into it here. Here are the slides. So we'll send you the slides tomorrow. Maybe it'll be the day after, but we'll send you the slides very shortly. And let me start off by describing what the purpose of the course is. The purpose of the course, the first purpose is empowerment. Empowerment in your investing. So many people feel disempowered in their investing in the sense that they feel like there's parts of investing that they just don't understand. And they also feel like they also feel that they don't know how to get started. They don't know who to trust. They don't know how to undo the mistakes that they've made in the past. And all of those things are very disempowering. And so we really work on that, giving you the feeling and the actuality of empowerment. And then, of course, the second purpose is to get you to better outcomes, for you to reach your financial goals, which you'll define during the course, to reach your financial goals more quickly. So empowerment and better outcomes. And how do we get to that? Well, we get to that with this content, through these things, through an investment process. And this is really the main part of the course, is developing an investment process and for you to work through that investment process yourself in a guided way. These 10 steps, one step per week, which I'll show you as we go along here. One step per week in our 10 weeks will take you through an investment process of making and implementing investment choices to define your goals and to get to your financial goals. All of the choices that you have to make, you'll have everything that you need to do that. And you'll work through this 10-step process of self-examination of what's right and what's wrong about your investing and to fixing what's wrong. Okay, so we have an investment process, and I'll show you what that's like. We have an investment strategy. So you'll work out your investment strategy. Now, strategy in investing is the what, the where, the how much, and the how of investing. What are you going to invest in? Aussie shares, global shares, US shares, residential property, commercial property, private equity, venture capital, etc. What are you going to invest in? Where are you going to hold those investments? Or we might say those assets. Where are you going to hold the investments, the shares or the property or the bonds or whatever? Are you going to hold it in your superannuation fund, in a family trust, in a corporate structure? Are you going to hold it directly, such as in negative gearing, etc.? All of those things. What are you going to invest in? Where are you going to hold it? How much risk are you going to bring in by borrowing to invest or to take out through insurance? Bringing in risk and taking out risk. And how are you going to implement? So are you going to use a financial advisor when you invest in shares? Are you going to use a discount broker? Are you going to do it through your superannuation fund? Are you going to use a full service broker? Are you going to use exchange traded funds, managed funds, invest in the shares directly? How are you actually going to bring it into existence? What are you going to invest in? Where are you going to hold it? How much risk in through borrowing and out through insurance? And how are you going to implement? That's what strategy is, integrating those things. And so we're going to have that, an investment process, part of which is investment strategy. We're going to develop a lot of knowledge about different types of investments that we were talking about, shares and bonds and property and private equity, venture capital, et cetera, different types of products, such as mortgages and insurance products and different ways of investing in shares, et cetera, different types of markets, the share market, the bond market, the money market, the risk markets, et cetera. And most importantly, and really the central thing in the course, is this week-by-week self-examination of your investing and taking you through 10 steps, taking you through this investment process week by week to get your investing right, to get everything right. And because you do it yourself, it'll be very enduring. This is the content that we have to meet the purpose of the course, empowerment and getting to better outcomes. Now, of course, we need materials to deliver on the content, to deliver on the purpose. And what we have is 10 2-hour classes. So these are from 7 to 9 p.m. on Thursday, starting on the 1st of May, and then running consecutively for 10 weeks. And then we also have the class videos on demand. So you can either come to the class live like this, or you can watch the videos whenever you choose. They sort of drop every Thursday night straight after the class. You can binge them if you want on the weekend, like the Game of Thrones or something. You can do both. You can come to the live classes and you can watch the videos, and plenty of people do that. And you'll have access to all of these materials for 2 years from the beginning of the course for 2 years. So if you think, oh, I missed a class, or something happened and suddenly from class 3 onwards I just couldn't do it, I had to put it off, don't worry. You'll have plenty of time to do the course and to do it more than once. It's extremely helpful to go through the material more than once, and you'll have 2 years to do that. So just back to our materials here. So we have the classes, we have the videos of the classes, which you can watch on demand. We have supplementary videos to take you deeper. And the most important part of the supplementary videos are videos on structuring and tax. There's 2 on superannuation. There are 2 of these videos on family trusts. There's 2 on taxation. There's 2, and these are 30-minute videos. There's 2 on borrowing to invest, negative gearing, as well as borrowing to invest in superannuation or lending money into your family trust. There's 1 on becoming a contractor, leaving employment and becoming a contractor, a professional services business or professional services income. And there's 1 on wills and estates, wills and estate planning. So there's 10 supplementary videos, 1 for each week. And I ask you to watch them separate to the live classes. And that really gives you everything you need to know about structuring and tax planning. People find that incredibly helpful. And I separated out from the rest of the course because that's helpful as well. Then, of course, we have a workbook, which I'll show you. You're going to work through your 10-step workbook, which will take you through the process of self-examination and development of your investment strategy. There are lots of PowerPoint slides. We have a learning management system, which I'll just show you here. So this is the learning management system. These are the different classes. This is the video player. You can play them on double speed if you want. That's a good idea. It's better to watch them double speed twice than single speed once. And you can think a lot faster than I can speak. This is the same thing. This is the learning management system, which is called Thinkific. This is the first class opened up. And you can see that the class is broken up into shorter videos. This is the first supplementary video down here, structuring and tax. This one's on family trust. There's another one on investment philosophy. So we have supplementary videos, the workbook, PowerPoint slides, and then we also have one-on-one discussions. So about 60% of the people who participate choose to speak to me for 30 minutes about their investment journey and find it extremely helpful. I sometimes think that the 40% of people who don't speak to me, they're worried that I am checking up on whether they've done their homework, on whether they have worked through their workbook, or they're worried that they'll have to reveal some personal information. But neither of those things is true. It's definitely not checking up on anything. But people do find that very helpful. And I like it too. I know it's not about me, but it is fun. In any case, these are the materials that we have for delivering the content to deliver on the purpose of the course. Now, I'll just tell you a little bit about me, which is not very interesting, so I'll just be super quick here. So I grew up in Perth, and that's where I live now. But I'm over in Melbourne and Sydney every fortnight. I'm at the Melbourne Business School. So I grew up in Perth, went to the University of Western Australia, studied engineering, met my beautiful wife, Tracy, at university. We both went to Canberra. Tracy worked for the Prime Minister's Department, also worked for the federal government. Then I did a master's degree in economics part-time. I got a scholarship from Solomon Brothers to go to the London Business School and do my PhD. When I finished my PhD, I went to Dartmouth University in the States for 7 years as a junior professor at the Tuck School there. In 2004, we came back to Australia. We only meant to go to the States for 2 years, but it was so fabulous we stayed for 7. Came back from the States in 2004. I wanted to work at the Melbourne Business School because that's the best business school in Australia, but we chose to live in Perth. So flying backwards and forwards a lot. But in any case, this is what the Melbourne Business School is going to look like once we've raised enough money to build this fabulous building. Many of you will know that's not what it looks like at the moment. But I've been at MBS for the last 21 years. Okay, now what else? Well, I've done a lot of consulting along the way. If you're a business school academic and you don't talk to businesses all the time, then you don't really know what you're talking about. So I've done a lot of consulting, done quite a lot of media, sort of more of this than these things nowadays. But my consulting has actually sort of transformed from being corporate consulting to being more in the wealth management space, the wealth space. And so, I teach courses, this course especially, for people whose wealth is sort of in this range. And then I do consulting for family offices who are sort of up here and for high net worth individuals. So consulting and education. I told you it wasn't very interesting. Now let's jump into looking at the course. Now, we're not going to work our way class by class through the course because that's just not informative or interesting enough here. But let me just say that we have an introductory class where we introduce what an investment process is and a set of ideas that we need. You shouldn't worry that the course starts at a level that is too high for you to understand. If you don't have any background in finance, don't worry about it. You'll be perfectly fine. This is not an MBA course or a university course or anything. There's no equations in the course. Look, we do take you deep. There's no doubt about it. And you really do learn a lot and get a very full and integrated understanding of investing. But, there's no equations, and we don't start at a high level. We start at a level that suits everyone, and then we go quickly. And for people who already know quite a bit about investing, you'll find that there's a lot that's explained in the course, especially in a different way to the way that you've heard it previously. And so, the challenge is to bring everyone along until we sort of get to a level where we can go very quickly. Don't worry either that we start at a level that's too low for you or that we start at a level too high for you. That's always a challenge for people who teach at business schools, and I've been doing that for so long that I know how to meet that challenge. Okay, but in our 10 classes, we have the introductory class. Then we have 3 classes on stock market investing, and you'll see why we talk about stock market investing first. Then we have 3 classes where we talk about property, residential property, houses and apartments, and then commercial property, offices and shopping centers and industrial property, etc. So 3 on property, 3 on stocks, shares, stocks and shares, stocks, shares and bonds. Those 3 things are all the same thing. I take a lot of care in the course to make sure that you understand what terms mean. So, stocks, shares, and equities are identically the same thing. Perfectly the same thing. Corporate tax credits, dividend imputation, franking credits, they are exactly the same thing. Not approximately, exactly the same thing. So you might think, well, why do they have to have 3 different names? Well, I don't know. And there's nothing we can do about that. But it is very helpful for that to be cleared up. It's part of lifting the fog of finance. It's part of the feeling of empowerment to know what these terms are and to sort out that kind of confusion. At the beginning of the course, I use those terms interchangeably. I'll say equities and stocks and shares. I'll say that here as we go through this introductory session. And you'll find it a bit confounding, maybe not with that simple example, but with other things. But eventually, by the end of the course, you don't even notice that I've used them interchangeably. And that's you having a lot of facility with investment terms, which is part of lifting the fog of finance, which is part of empowerment and getting to better outcomes. So we work through 3 on stocks, 3 on property, and then we work through defensive assets, through private assets. These are sometimes called alternative assets, infrastructure, private equity, venture capital. We'll talk a little bit about what they are in just a moment. And then we bring the course to an end with the completion of the implementation of your investment strategy. So those are the 10 classes. Now, as I said, it's too boring to sort of go through all of those. Not boring, but it's just not the best thing to do. The best thing to do is to just jump into the middle of the course somewhat. So I'm going to jump, not exactly into the middle of the course, but I'm going to jump into talking about strategy. Talking about the what. This is strategic asset allocation. What are you going to invest in? How much? It's strategy. And we're talking about different asset classes: Aussie shares, global shares, US shares, residential property, commercial property, venture capital, infrastructure, etc. Different asset classes. How much are you going to allocate? How much of your money, what percentage of your money are you going to allocate to different asset classes in your strategy? I know this is a piece of jargon to call it strategic asset allocation, but that is what people call it. This is the what of investing. What are you going to invest in? And then where are you going to hold it? Now, people call that structuring and tax, because the structures are a self-managed super fund or an industry super fund. That's a structure. Corporations are structure. A family trust is a structure. So what kind of legal structures are you going to use to hold your assets? And what's your tax strategy going to be? How are you going to use the peculiar nature of Australia's tax laws? We have a lot of things that nobody else has. We have family trusts. Some countries have that, but we have dividend imputation. We have negative gearing, which most countries, hardly any other countries have. We have a very specific set of tax laws and arrangements and regulations. And we really come to understand that deeply, how you should integrate that and make that work for you in your investment strategy. That's so much of what those supplementary videos are about. There's 10 supplementary videos on structuring and tax. So what are you going to invest in? Where are you going to hold it? How much risk are you going to bring in or to take out? How much risk? How much are you going to bring in through leverage? This is borrowing to invest. Leverage, gearing, borrowing. Everything in finance has to have 3 names. There's nothing we can do about it. We just get familiar with it. But borrowing to invest, that's bringing risk in. That's moving to a higher risk, higher return point. How much are you going to do, if any? Usually this will just be with property. How much risk are you going to take out through insurance? We're going to discuss that at length. And then how are you going to implement? How are you going to actually bring it into existence? It's not enough to understand all of this. If at the end of the course you think, oh, well, that was really interesting and Sam's kind of a funny guy, I hope you do think that. But if it doesn't change your investing a lot, if you don't implement a much better strategy and better investment process, with strategy being part of the process, if it doesn't change your investing a lot to get you to empowerment and better outcomes, then the course is a fail. So implementation is absolutely essential. It's not enough to understand. You've got to change things in your investing. Now, these 4 things, as suggested by this graphic, these 4 things go together. And we jump somewhat into the middle of the course, not exactly in the middle, but we have jumped, there's a lot of explaining to do before we get to here. But I'll just jump to this because it helps to understand the course if you kind of jump to the middle. Now I'm going to unpack this. I'm going to take us on a narrative with a young couple through their life and see the way that they use different structures. And you'll see, this will help you to understand what the course is like, the way that things get explained in the course. Okay, so let's do that. Let's go on this narrative. And this is about where to hold your investments. Remember, strategy, integrated strategy. What are you going to invest in? Where are you going to hold it? How much risk in or risk out? How are you going to actually bring it into existence? Are you going to use an advisor? What kind of instruments are you going to use, such as, I know instruments is another piece of jargon, but an instrument is just a tool for getting something done. A musical instrument is a tool for playing a note. An instrument is a tool for getting a specific thing done. So we have instruments in finance. So, what kind of tools, what kind of products are you going to use? You're going to use managed funds, exchange traded funds, etc. So what, where, how much risk in or out, and how are you going to implement? How are you going to bring it into existence? Now we are going to unpack this using a narrative of Tom and Mithra. Okay, here's our young couple, Tom and Mithra. Tracy thinks Tom's a bit too old for Mithra, but I think it's probably okay. And they are early in their journey, so they're not making a lot of money yet, and they are saving to buy a home. And they're saving partly through their super, using the First Home Super Saver Scheme, excuse me, and partly outside of super. Now, what we want to do is look at how they use these different structures as they go through their investment journey. And so they're going to carry their wealth from today into the future in these different structures. So they might use super, concessional super, that's before tax super. I'll explain that more in just a moment. They might be building up their wealth by paying down their mortgage, building wealth in home equity. They might have a negatively geared property. They might be building their wealth in non-concessional super. This is after tax super. They might have a family trust. They might be building a business. Now, these are the 6 main ways that you can carry and build wealth into the future. And we're going to unpack this using the example of Tom and Mithra. And we're going to do it by looking at their cash flow diagram. So this is their salary and other income. So they might have an investment property and be receiving some rent, but these are their salaries. And this is their spending. And everything between what they earn and what they spend is either taxation or it is saving. It's a form of saving or it's taxation. We're going to fill this bit in and understand the structuring and tax. So the first thing is that they can put money before tax into super, concessional super. And that's a very helpful thing. You have to pay a contribution tax on the way in, depending on how much you're earning. If you're earning more than 250, then you get taxed 30%. If you're earning less than 250, it's 15%. We unpack all of that in the course. And they have been saving hard into their super because they're going to take some money out of their super through the First Home Super Saver Scheme to buy a home. Now they have to pay income tax, of course. That's money out. And then they're saving outside of super to buy a home as well. Now we make a strong distinction between what's before tax and what's after tax in our diagram here, and give them different colors. Okay, let's move them along a little bit. So now they have bought a house and they put 200K of their own money into the house, and 100K of that came out of their super, 50 each. That's the First Home Super Saver Scheme, as I said. So their super goes down and they had another 100K that they put into the house, and they borrowed 800K. I know $1 million doesn't buy that much, especially in Sydney and Melbourne nowadays, but let's just start with this simple example. So they buy this relatively modest house, and they are repaying the mortgage. This is where their money's going at the moment. It's going into tax, it's going into interest, it's going into super, it's going into the repayment of the principal. Now we move along a little bit, and the value of their house has gone up because they paid the debt down a little bit, or their equity has gone up because they paid the debt down a little bit, and the value of the house itself has gone up. And then we move along, and their supers accumulate a little bit more, and then we move along a little bit more, and we get to this point where they buy. We get to this point where they buy a nicer house. So they bought a house, paid the debt down a little bit, their incomes went up, they bought a nicer house. So now they've got a $2 million house. They use the equity that they had in their previous house here to buy a nicer house. Now they've got a lot more debt. And then they move along a little bit. And eventually they get to this point where they'll face this tension. Should they use their savings to repay their mortgage, or should they put their money into concessional super? What's the best use of their money? Should they pay down their mortgage, or should they pay off their super? This is the kind of question that we've got to face in the course. This is a structuring and tax question. At what point do you stop paying down your mortgage and start maximizing your super? Now, the notion that you pay your mortgage down to zero and then you start worrying about your super, that's just wrong. That's not the right idea. And we really bring that out in the course. And we'll understand this tension and other tensions and how to think about it properly. So anyway, they reach this tension, and it's a tension because the return on repaying your mortgage, let's say that they put $1,000 of after-tax money. They take $1,000 here, $1,000 of after-tax money and they put it in here. And if their interest is 6%, let's say, so they're paying 6% interest, if they put $1,000 of after-tax money in here, then every year they will pay $60 less interest. You know, their $1,000 investment in paying down their mortgage will give them a 6% return, $60 of extra after-tax cash that they've got because they don't have to pay as much interest. Now, in general, it'll give them inflation plus 2.8%, and we'll see why that's true in the course. But a really nice thing about the return on this form of saving, you know, paying down debt is a form of investing. This form of saving or investing, a really nice thing about it is that it's after tax and it's risk-free. And you can't really get a risk-free return, after-tax return of that much anywhere else. But you could put your money into super. And remember that to get $1 down here, you've got to have $1.64 up here because the government wants 32% of it. The 34.5 actually, once we throw in the Medicare levy, because the government wants a big cut of this. $1.64 up here is $1 down here. So instead of putting $1,000 in here, they could put $1,640 in here. Now, to get taxed at 15%, but they'd still have $1,390 going in here instead of $1,000 going in here. Now, it's risky. Putting money, it's going to be invested in shares and bonds and property and venture capital and the like, so it's not risk-free. And we have to think about it after tax. We have to make some adjustments to have an apples for apples comparison, but the return is much higher up here. You know, for almost everyone, at some point, they're going to favor this over that. They're going to pay down their mortgage until they feel sufficiently comfortable, and then they're going to start sending their money in here. Now, at what point to do that? That's the kind of thing that we talk about in the course. We're going to see in just a moment they've got other options. They could have a negatively geared property. They could have a family trust. They could put money into super after tax. And we've been talking about this tension already. But ultimately, there's a bunch of different things they could do with their money. And unpacking which is the best strategy for you in terms of structuring and tax, you know, that's a central part of the course. So anyway, move along a little bit with them. And where do they get to? Well, they get to buying a investment property. They decide they maxed out, they paid down their mortgage, they maxed out their concessional super. And now they think, well, we still got extra savings. So what are we going to do? We're going to use some of our pre-tax income to support an investment property. Now, there's a question here. Would they pay down the principal on the investment property? No, that's almost never a good idea. And the reason is that you get a nice return on paying down the debt, but down here, that return is after tax, and up here, it's before tax, the return. So you might be getting, for every $1,000 you put in here, $60 less interest payment per year. But up here, it'd be $60 of before tax income, not after tax income. And we saw just a moment ago that after tax income is worth a lot more than before tax income, especially as they move into higher tax rates. So they wouldn't do that. In any case, they move on a little bit, and then they think, well, should we start putting some money into super? Now, a lot of people do that, put non-concessional money, after-tax money into super. That doesn't have to, you don't have to pay a contribution tax, but it is after income tax. And this will typically be people who want a very simple arrangement. Simplicity is a beautiful thing. A simple arrangements in their investing and relatively low risk. So low complexity and low risk, this will really work for people who want that. This is higher complexity and higher risk, but higher return as well. And then they might be thinking, well, should we start a family trust at some stage? Now, Tom and Mithra have moved along, some children have come along, and they decide to start a family trust. And they put some money into the family trust. Let's just have a look at a family trust here. They put some money into a family trust. They gift the money into a family trust. What else could they do? Well, let's just worry about that later. And what is a family trust really, and how do you set it up? Let's just, you know, that's the course, right? Understanding these kind of things. But they put some money into the family trust, and then when the family trust earns income or capital gains, when money is created in the family trust, then you have a lot of discretion. That's why they're called discretionary trusts. You can send the income. Let's say they own some shares up here. When the shares pay dividends, income, or if they owned a property and the property paid rent. So shares or a property, either way, dividends as income from the shares or rent coming as income from the property, they can send it to whoever they want. Now, they won't send the income to Martha or Tom because they're on high income tax rates. And they can't send it to the children because they're not 18 yet. So what do? Well, they put it into a bucket company. They set up a company down here, which is not very expensive, and setting up family trust is not very expensive either. I'll take you through the whole thing. And they send the money from the family trust down here. They let the bucket company fill up. with the distributions of the dividends from the shares or the rent from the property, fill up here until the children turn 18. So you can see here, this is us moving through time. So Tom and Mithra are on high income, so we don't want the distributions to go to them. The kids are not 18 yet, so we don't want the distributions to go to them, so we fill up the bucket company. But then, when the kids are at university or in some kind of education, when they're on low incomes, we drain the bucket company. We send the money from the bucket company down to them, and they won't pay any tax or very little tax. And then we let the bucket company fill up again, and then eventually Tom and Mithra will retire. And when they retire, we'll drain the bucket company again. So this is just a very standard strategy. This is the most standard thing in the world. You shouldn't think for a second that, wow, once the tax office hears about that, there'll be a big red alarm bell next to our name in the ATO. That's absolutely not true. There's 900,000 family trusts in Australia, and about 2/3 of them have a corporate beneficiary like that, a bucket company like that. It's really just the most standard thing in the world, and they're incredibly helpful, family trusts. And we're going to unpack that completely as we go along. So anyway, here we are looking at, using the story of Tom and Mithra and them sort of traveling through their life using a narrative. We use narratives all the way through the course to explain things in this way. Diagrams and narratives to explain, relatively complex things and to stitch it all together. But, we were talking about this tension early in their journey between should they max out their concessional super to 30K or should they pay down their home equity? Eventually, the tension will be down here. Should we be putting money into a family trust, or should we have negative gearing? Should we be putting it into super? What should we do? And when should we start doing these things? Should we start on these things before we completely pay off our home? And how should we use the equity in our home to do these other things in any case? That's what structuring and tax is. And it's this part of our integrated tax strategy. Now, we just unpacked this part. We sort of jumped into the middle of the course, and we've unpacked this part. And you can see in the graphic here that this is intended to be integrated. You have to make these choices together. And I'll show you how to do that. Now, it sounds like it's really complicated, but in some ways it's not, right? If you go to a Mexican takeaway restaurant, then you have this situation. You've got to decide, where am I going to put the food? What am I going to have? And how much? Okay. Now, the investment strategy isn't exactly the same, but it's similar. Where am I going to hold my investments? What kind of investments am I going to have? And am I going to supersize them by bringing in debt? Or am I going to shrink down the risk by holding more cash? And am I going to protect the risk with insurance? So look, it sounds complicated, but it's not. There's a lot to know, and we work through it in the 10 weeks. We take you deep, but look, it isn't rocket science. It just needs to be fully explained for you to understand. Okay, let's keep going here. Let me just sort of take an example of the importance of getting these things together. Now, you might decide, I'm going to buy a rental apartment, I'm going to put it in my family trust, and I'm not going to borrow too much money. Now, because I haven't borrowed too much, and because apartments pay relatively high rents, this is going to throw off some cash. Not all of the rent is going to go to service the debt. So it's going to throw off some cash, and we'll be glad that it's in the family trust because we have discretion across the family members and across time using a bucket company as to where we send the cash. So this is a good integration. Now, with negative gearing, we might buy a rental property in a leafy suburb, for instance, which has a low yield, and we're going to have a lot of debt. Because it doesn't have very high rent and we have a lot of debt, then the rent is not going to cover the debt, going to cover the interest. And we're going to have to top it up. We're going to have to send some of our pre-tax income, just like Tom and Mithra, to support the property. Now, we'll be glad that we've got it outside the family trust so that we can do that, so that we can combine the loss on the property with our income from our salary. If you put it into the family trust, you can't do that. And so you can see here, getting the what, the where, and the how right is absolutely essential. Sometimes you see people buy apartments and own it directly, and they start off with a lot of leverage, but eventually they don't refinance, and they end up with low leverage, and now they've got a lot of cash being thrown off, but it's not in the family trust. And they can't get it into the family trust without selling it and realizing capital gains. And, and equally, if you had a negatively geared property in the family trust, you wouldn't be able to put the loss against your salary income. You've got to get these things combined in the right way. And to do that, you've got to understand how it works. Here's some other examples, which we'll work through as we go through the course. So, here we've been talking about strategy, and strategy is a part of investment process. And let me just sort of show you that. I know we jumped into the middle of the course, and I know that I'm going at 1,000,000 miles an hour here, And you might be thinking, well, he left that slide and he didn't explain everything on the slide. Well, we're sort of flying at 30,000 feet here, and when you fly at 30,000 feet, you can't see everything on the ground with perfect detail. But in the course, we go through everything in perfect detail, and we don't leave any slides. We don't leave questions hanging in that way. Now, let's just sort of zoom out and talk about investment process for just a moment here. So investment process, as I said at the beginning, is really so central for us. And it's the process of making choices and implementing choices. Now, the first thing you got to do is to define what your financial goals are. And this is the first step in our 10-step process. And your financial goals come out of your life goals. I mean, money is your servant and not your master. You have financial goals to live the life that you want to live. But your financial goals come out of your life goals. And then you have to make choices to reach your financial goals. But there's something else here. Here are the choices, I should say. So you have your life goals, financial goals. You have to make choices, make and implement choices to reach your goals. And over here, we have some that are not to do with strategy. How much of your money are you going to save? Are you going to get a financial advisor? But all of this is strategy. These choices are all about strategy. Now, there's something else, and it's this. Where you are on the risk spectrum, from low risk to high risk, is going to affect your choices. And where you are on the risk spectrum is not itself a choice. It's just a recognition of your personal characteristics. So, do I have a highly stable income? Am I a doctor in a public hospital? Or am I a building company? That's really going to affect it. I mean, if you own a building company, you've got enough risk. You've got high risk, high return in your building company, and your investments are about wealth preservation. So you're going to want to be down here. You've got enough risk in making money. But if you're the doctor in the public hospital or a teacher or the like, then you can take a lot of risk in the making of money, in the investing of money, because there's such low risk in your making of money. And this is not really a choice. It's a personal characteristic. How old you are, personal obligations. I don't mean normal familial obligations like having children or parents. I mean sort of exceptional obligations, like a child with special needs, for instance, is going to put you more to the left on the risk spectrum. Your personality is going to matter. What your recent returns have been. I'll show you what that means in the course. It takes a little unpacking. How much wealth you've got. And especially how much more wealth you've got relative to your financial goals. If you're already a long way along towards reaching your financial goals, then you can afford to take more risk. But these are not really choices. These are recognition of your personal characteristics. And we position you on the risk spectrum, and that goes into making these choices. Your goals, your position on the risk spectrum, and a lot of these choices are about strategy. What are you going to invest in? Where are you going to hold it? Risk in, risk out. How are you going to implement? Now, we were looking just a moment ago down here, structuring and tax. And now we're just going to have a quick look here at asset allocation. And because that'll show us the different asset classes that we look at. This is the what of investing. It'll show us the different asset classes that we look at in the course. And they're these. We look at shares, stocks, equities. We look at real estate, residential real estate especially, but commercial real estate as well. Houses and apartments up here, and shopping centers and office blocks and industrial property down here. We look at private assets, which I'll describe some more in just a moment. We look at bonds and cash. These are defensive assets for people who don't want to take very much risk. Now, asset allocation is deciding how much of your wealth goes into each of these asset classes. And here I'm just taking an example of someone who wants to take a relatively large amount of risk. Not only are they investing in risky asset classes, but they're borrowing to invest. You see, they put 20% of their money into buying an apartment. This might be Tom and Mithra. They buy an apartment, and they've got all of that exposure to the apartment, the upside and the downside, but the bank put in 80% of the money. So they've got a lot of exposure, but they only put in 20 of their wealth, and the bank put in the other 80. That's what the meaning is here. But this is someone who wants to take a relatively significant amount of risk. It's just an example. It's not you or me. It's an example. Maybe it is you, maybe it is me, but it's just intended to be an example. Let's have a look at Aussie shares. So we look at public equities, Qantas, BHP, CSL, Commonwealth Bank, Coles, etc. These are public because they're listed on the stock market, listed on the Australian stock market. But there's companies that can be invested in that are not listed on the stock market. And that's what's referred to as private equity. And private equity is an important asset class. It's not what we're referring to here. Here we're referring to the stock market, the public stock market. But private equity is important. And venture capital is even smaller. These are startup companies. coming out of universities, or people dreaming up ways of starting new artificial intelligence companies or biotech companies, etc. They're usually tech companies, but these are startup companies that people can invest in. Now, when we say Aussie shares, we mean the stock market, and private equity and venture capital are part of private assets, which we'll come to in just a minute. Now, we're going to look at global shares as well. Investing in global shares is so essential for Aussie investors for reasons I'll explain to you in the course. And we'll go around and look at how to do that and why to do it. We'll look at the ways of investing in shares. Are you going to use managed funds or exchange-traded funds? Are you going to buy the shares directly using a discount brokerage like CommSec or NAB Trade? Are you going to use a full-service broker like JB Weir or Ord Minnett or Evans or Morgan or one of these sort of private banking type wealth advisors? We'll look at the practicalities. This is about the implementation of investing in shares. Down here, we're making a comparison between managed funds and exchange-traded funds as different ways of investing in shares. Now, you might be thinking, well, he hasn't explained what managed funds and exchange-traded funds are. Well, look, I know, and I wish I could, and of course, that's what we do on the course. But in the overview, this is a good example of Sam just showing a slide and then not explaining everything that's in it. But it's just meant to demonstrate that we really unpack everything to do with the stock market and how to implement investments in the stock market. Now, here I want to show you an example, and the purpose of this example, this will take a couple of minutes, and here I really am going to unpack it. And the purpose of this example is to show you that relatively complicated things can be explained without using equations, but just using diagrams. And this is what happens throughout the whole course. We don't use any equations. If you're thinking, I haven't done any math since I was in high school, don't worry about it. No math appears in the course. We are able to explain complicated ideas without using diagrams. Okay, here we go. Here's an example we're going to explain. Here's an example we're going to explain what dividend imputation is. So Abner receives a fully franked dividend of 98 cents for each of his 5,000 BHP shares. So 5,000 times 98 cents, he's got 4,900 in a dividend. And then the tax department, in working out how much tax he has to pay, here's what they do. They say, before BHP paid corporate tax, it was $7,000. And then BHP paid 30% corporate tax. That's what companies have to pay in Australia. They paid 30% corporate tax, and then they paid the dividend, the remainder, out to Abner and other shareholders. But before Abner's 4,900 was paid out to him, originally it was 7,000. And so they've grossed up. This is net of tax. This is gross of tax. And then they say, well, he owes us tax on the whole 7,000. And how much tax does he owe? Well, it just depends on which tax bracket he's in. If he's on the highest tax bracket, he owes us 47% of the 7,000. A lower tax bracket still, he owes us 2,240. If he's a corporation, if it was like the bucket company owning shares, a corporation owning shares pays 30% tax. In your super, you only pay 15. And then if you are retired, you don't pay any tax. So then the tax department says, okay, well, Abner, depending on where Abner is in terms of taxation, Abner owes us this much tax. But this tax has already been paid. Abner has got a credit for this amount of tax that's already been paid. So let's apply the credit. So Abner only has to pay us this top-up tax because Abner's got credit for this amount of tax already paid. Or if Abner's on this tax rate, this amount, or nothing extra if Abner is a corporation. Now, if the shares are held, if Abner is holding the shares in Abner's super, but hasn't retired yet, is in accumulation phase, Abner will get a big refund. And if Abner is retired, Abner will get all of the money back. All of this tax paid by BHP will be refunded to Abner. Now, look, I only bring this example out to show you that complicated things can be explained. Complicated things can be explained without resorting to mathematics. And look, I know we went through it quickly, and we would take more time and use more examples in the course, but I think it's a good demonstration of that. And so we work through lots of things in understanding the share market. We have a bit of fun as we go along, of course. And then we talk a lot about residential real estate, three whole classes. We talk about houses and apartments. We talk about commercial real estate as well, offices, retail, industrial, specialty. This would be aged care or childcare, or gyms, etc. And then, we look at here, I'm just sort of showing you some example slides. Here we're looking at thinking about, do we want to do negative gearing, or how are we positioning negative gearing relative to other ways we could use our money in these different things. And we're really bringing that out and discussing it in good detail. We're thinking about the different nature of different types of investments. This really matters, that apartments or houses in regional areas, they pay high yields. So there's quite a lot of cash comes out of them, but they don't have a lot of growth in the value of the house or growth in the cash. Now, a house in a leafy suburb has a much lower yield. In a $1 million apartment, you might have a net yield of $35,000, but it's not growing very quickly. This is sort of inflation plus 1%. Whereas a house in a leafy suburb, $1 million house might only have $15,000. $2 million house might only have $30,000 in net rent, but it grows a lot quicker. So these are growth assets rather than income assets. And once you add debt to this, then not only do you not have low income, you have negative income, but you have much higher growth. My diagram doesn't show the growth being very high, but that's because it's been squeezed into this corner. But you have much higher growth in the money that you've invested in the strategy, in the negative gearing strategy. Commercial property is more like apartments. It's more of an income asset than a growth asset. Now, this is really important for understanding what's going to suit you and what your tax strategy should be to go with those things. This diagram, again, I'm not going to explain all this. I'm just going to show you that we use diagrams rather than equations to explain everything. This is an off-the-plan apartment. Imagine that Tom and Mithra have purchased an off-the-plan apartment and they have borrowed all the money. They've used the equity in their home to borrow the money in an off-the-plan apartment. They're getting some rent. Then they have to pay expenses, like maybe they have to pay the management fees. They have to pay the strata, etc. They have to pay insurance, etc. So they've got the gross rent, expenses, net rent. The net rent doesn't cover all the interest, so they've got to put some of their own money in here. But there's another expense here that they're going to cover here, which is depreciation of the asset. You see, an off-the-plan apartment is a new apartment, and the tax office allows you to have an expense for the depreciation. I know I haven't really explained what depreciation is here, but they allow an expense. But the money is not actually going to anyone. Here, the strata money goes to the strata group, and the agent's fees go to the agent, and the insurance goes to the insurance company. The interest goes to the bank. The depreciation expense doesn't go to anyone. It's an expense, which means that you've made a loss and you've got to cover that loss, but the cash doesn't go anywhere. You've still got the cash. All that's happened is that some of your pre-tax income has been shielded from income tax by depreciation. It's a reduction of tax through depreciation. And we use diagrams and examples to really bring that out. Now, we do have some sums in it so just some arithmetic to work through the example, just put some numbers onto it. But it's not sort of mathematical like that. Well, let me speed up a little bit here and finish up. So in this example, what we're looking at is a zone of low competition in commercial property. And, wealthy families can buy commercial property up to about here, but then they drop away because there just aren't that many wealthy families. And big institutions like Australian Super and real estate investment trusts, they buy property down to about here, but then it's just not worth it. If you've got $50 billion to invest, how many petrol stations on the Hume Highway do you want to own? How many little warehouses near Brisbane Airport do you want to own? So the institutions drop off here and the wealthy families drop off here, and there's a zone of low competition in commercial property. And here, just by way of example, we're looking at property trusts that target that zone of low competition. These are really good for wealthy investors. Okay, what else? Well, private assets are about private equity and venture capital we were talking about before. Infrastructure like airports and ports and power stations, etc. Cloud computing. Private credit, which I'll sort of describe on the course, and hedge funds. So these different types of private assets, mostly the way to get to these private assets is through good super funds. And I'll explain that to you on the course. And then what else? Then we talk a lot about bonds and cash. These are defensive assets, bonds issued by corporations, governments, banks. I know I haven't explained what they are, but I just want to speed up a little bit here. Bonds and cash are defensive assets for people who don't want to take a lot of risk. They don't want to have a lot of allocation to risky asset classes or borrow to invest. They want their money safe in corporate or especially government bonds or in cash in the bank. And so we talk about that. We talk about offset accounts and different ways of investing in cash. Throughout the course, we look at places where you can go and find information about different products. Here it's about cash. We look at some other things that you can invest in banks, like bank bills and hybrid notes and tier 2 bonds, etc. We look at what these different levels of risk are in investing in bonds. And then let me just remind you that in the course, I take you through this 10 steps. Here they are. In the first week, we set your goals. In the second week, we work out where you should be on the risk spectrum on the basis of your personal characteristics, and then where you are on the risk spectrum. And then later on, we look at strategy. So where to hold your assets in 1 week, what to invest in another week, taking risk out using insurance, implementation. Down here, this is really about control, working out whether you're saving enough to reach your goals, budgeting your money properly. Do I need financial advice? Because financial advice is handing over your control to somebody else. So each week, we're answering, one of these simple questions in working through our 10 steps. Now, this is the last thing I want to show you, and then we'll go to any questions that you have. So the last thing is this, that we use narrative characters to take you through the 10 steps. So it's, without these examples, it'd be hard to know, not hard to know, but it's helpful to see these narrative characters work through their 10 steps, work through their workbook. And that sort of shows you. I give you all the knowledge that you need and the structured opportunity and the workbook and everything. And then the example of these narrative characters working through their 10 steps. People find it extremely helpful. So we have a young couple, Ravi and Jess. We have a single person, Brooke, who's a lawyer in the Attorney General's Department in Canberra. Ravi and Jess. Ravi's a teacher. Jess owns a travel business. Brooke's a lawyer. Beck and David are near retirement and have children and grandchildren, and they're a wealthier couple. And then we work through the workbook. So I give you this workbook, and we work through the workbook week by week. So here we can see Ravi and Jess setting their goals, writing down their financial goals. And here we can see Brooke working out where she is on the risk spectrum in the second week. And here we see Brooke working out, in the second week, she's working out where she should be on the risk spectrum. And in the third week, she's working out where she actually is on the risk spectrum on the basis of what her investments look like at the moment. And you can see there's a big gap here. She's not taking enough risk. This is very common. Plenty of you will be like this. You will have spent most of your investment journey paying down the debt on your home. And eventually, that means that you are not taking enough risk. And a big gap opens up between the amount of risk you should be taking and the amount of risk you are taking. And here we've got Beck and David working out whether they have saved enough money to reach their financial goals. We have a calculator for that purpose. We take you through this. Here we're looking at tracking your spending. Brooke uses a bank app, and Ravi and Jess and Beck and David use other solutions. Here in step 6, we are turning to strategy, and we're looking at which of these structures Brooke is going to use at different parts of her journey. And we do the same for David and Beck and Ravi and Jess. And then here we're looking at asset allocation, what they're going to invest in, and we're matching up what they invest in with where they hold it. Now we're starting to really bring everything together. And then we look at insurance. Here we're looking at how much insurance Ravi and Jess need. And we have a long discussion of all the ins and outs of insurance. Here we are looking at whether they need financial advice or not. And Brooke doesn't need financial advice because she's highly engaged. Her situation is not that complex, and she's highly engaged. Ravi and Jess are here. They have a low complexity, but they're not very engaged either. And David and Beck choose to use a financial advisor because they don't want to do it themselves, and they've got a complex situation. And then finally, we turn to implementation. And we look at how you implement the what of investing. What are you going to own? Where are you going to hold it? And what's your implementation strategy? How are you going to implement? So it brings all of those things together. And in the course, we work week by week, developing your investment process. We use videos and supplementary videos. We work through all the different asset classes. We develop a huge amount of investment knowledge. So the course starts on the 1st of May, runs for 10 weeks. It's from 7 to 9 p.m. It is $1,600 plus GST. $1,600 is not nothing, but, compared to how much extra wealth you will have over time as a result of getting your investing working, really is, you'll have a huge return on investment here. Okay. Now let me turn to the chat. Turn to a couple of questions here. So Rose says, thanks for the session. Are the live class videos, are they interactive? So the live classes are interactive. So, we have quite a few people, quite a large number of people in the class. So they're interactive in the sense that, I give the class and then we have questions at the end. And usually the questions go on for quite a long time. There'll be 20 or 30 questions and we will discuss them for 30 or 40 minutes at the end of the class. So it's interactive in that sense. Sometimes I invite people, we have a break in the middle of the class and I invite people to ask questions at that point. When we come back from the break, just turn your microphone on and ask a question. And so we do that. But, it sort of runs more smoothly if we have the questions at the end. And that's what we do. Duncan says, the bank of mum and dad is quite the topic of late. Yep, absolutely. If parents invest in their kids instead of investing in the bank, like term deposits, do the parents pay tax on the interest they charge the kids if the loan from the parents is into the kid's principal place of residence? Well, look, if it's your money, you can lend let's say the money's in the family trust. Let's say that Tom and Mithra, their kids have grown up and they've got some money in the family trust and they want to lend some of the money to the kids. Okay. So they make a loan. If the money's in the family trust, let me just sort of show you here. Okay. So time's moved on and now the kids have grown up and they say that Rose wants to buy an apartment and they want to lend her some money from the family trust. They don't have to charge her any interest at all. So it's entirely up to them. They can choose to Mithra and Tom can choose not to charge Rose any interest if the money comes out of the family trust. It's their money, right? And tax has already been paid on it. The money that they put into the family trust was money that was after tax, as we saw up here, right? It's after tax money going into the family trust so that they can lend it to their kids with zero interest. If they lend it to the kids and charge interest, then it's going to be income. Absolutely. Yes, it'll be income and they'll have to pay tax on that income. If they lend the money out of the bucket company, that's a different thing. That's a Division 7A loan. And, we talk about that in the course. Another consideration is that if they lend the money to Rose, and they're a bit worried about whether Rose and Rose's partner are a permanent item, then that's why they might want to lend the money rather than gift the money. Rather than giving the money to Rose, they might want to lend it to Rose. And, we talk about those kind of practical considerations of the bank of mum and dad as well, right?